Bull-Tech Capital Chief Market Strategist Kathryn Rooney Vera. Great to see you both this Monday morning. Thank you so much for being here. Kathryn, kicking things off with you. The start of a big week. Futures are higher right now as we look ahead to the November Consumer Price Index out tomorrow. We're expecting a gain of 0.3% month over month and 7.3% year over year. And then, of course, the Fed begins its two-day meeting tomorrow, the final meeting of the year, where we are expecting higher rates. Kathryn, what are your expectations here?
Well, I think the Fed does hike 50 basis points. I think they go higher to 5.5. We're at probably going to end the year at 4.5% on the upper bound. But inflation is decelerating. Tomorrow we're going to get inflation, or this week we'll see inflation prints decelerate down to slightly above 7%. And Maria, if you've seen the used car lots, if you pass by any of them throughout the country, you see that they're now full. So that shows that a lot of the supply chain distortions that we've seen and the impact of higher interest rates is flowing through to the real economy. So the supply side is going away. Oil prices have crashed, so the price at the pump is less egregious. Used car prices are dropping precipitously. So this tells me that the supply side has corrected itself, which means that inflation is going to drop big next year. That's my view. I think we've seen the peak already. We topped out at 9% year over year this year. And I think that what's missing now is the demand side. Labor market has to roll over. I've been saying this for some time. Salaries are up 6% year on year. The Fed has to force that lower. That means a contraction in demand. So more likely than not, the Fed continues to hike. And depending on the magnitude of the recession next year, the Fed could change course and either by the end of next year or early in 2024, start cutting rates.
Yeah, I mean, that's what people are expecting given the impact of all of these rates. But you're talking about the demand side. The demand side is weakening, right? How weak will it get? I mean, when you look at your expectations for 2023, they include a slowing economy. How are you positioned going into that? Do you want to buy stocks? Do you want to take to the sidelines?
So the consumer is 2/3 of the U.S. economy, and the consumer has been remarkably resilient. And that's because unemployment is near record lows and there's an abundance of jobs out there. Once that shifts gears, we're going to see revisions in earnings expectations for next year. I think we're going to actually get earnings recession. It makes sense. Earnings expectations are way too high from my perspective. So what we need to do is, it's great right now, Maria, to have cash and cash equivalents. Look at T-bills. Look at commercial paper. Look at short-term bonds. You can get 4.5 to 5% yields on 3-month duration stuff. So okay. I think that's where we want to be for now. And as we go into 2023, and as everyone, you and I and everyone else, starts talking no more inflation, how bad is this recession going to get? Then we want to go into longer duration fixed income. I think next year is going to be the year of fixed income. I know it's increasingly consensus. It's been my view for some time.
Okay. All right. Great to see you both. Thank you so much for the word on Wall Street. Michael Lee, Kathryn Rooney Vera, have a great Monday.